Welcome to the deep dive. Today we're getting into something that, well, affects all of us. Money. Specifically, the surprising psychology behind our financial choices.
And how your own unique history uh, profoundly shapes how you see it all. You sent over some really fascinating material on this.
Yeah, and the core idea seems to be that doing well with money isn't just about being smart, having the knowledge. Behavior is huge.
Absolutely critical. And that behavior, it's not random. It's really rooted deep in our personal experiences, the things that make up our own financial story.
It makes you think of stories like Ronald Reed, the
Yeah.
janitor and gas station attendant,
Right, lived a very quiet life.
but ended up a multimillionaire philanthropist through just, well, steady, quiet investing.
You contrast that with, say, a high-flying executive, someone you'd assume knows finance inside out, who maybe makes some reckless decisions and ends up broke. It happens.
It really does. So how does the janitor build wealth while the expert might lose it? That's the puzzle.
And that's what we're diving into. Why these seemingly irrational money choices actually make a kind of sense when you look at the person's life story.
So the mission today is to unpack how our backgrounds shape our financial outlook, hopefully giving you some insights into your own habits and maybe understanding others a bit better too.
Without getting bogged down in, overly complex theories, just practical understanding.
Okay, so where do we start? One thing that jumped out from the sources is this gap, right, between knowing what we should do with money.
And what we actually end up doing.
Yeah, we know the basics: save, invest wisely, avoid sons of debt. But actually doing it consistently, that's the tricky part.
It really is. And it's interesting if you compare it to, say, the health field.
How so?
Well, over the last century, we've made incredible leaps in understanding the human body. Science has led to huge improvements in health lifespans.
Sure, we know much more about staying healthy.
Exactly. And while challenges remain, knowledge has clearly driven better outcomes. But in finance, it feels different.
We have tons of information. Financial education is everywhere.
But it doesn't always translate into better behavior, does it? Not consistently across the board.
So why is that?
Yeah.
One of the sources had a really interesting take that we tend to treat money like it's physics. Fixed rules, formulas.
Predictable. Input A leads to output B.
Right. But the argument is money is much more like psychology. It's tangled up with emotions, biases, our own personal histories.
That's the core of it. Everyone's experiences are unique, and those experiences build our model of how the financial world works. It's not objective, it's subjective.
Give us an example.
Okay, think about growing up in poverty versus growing up with wealth. Your view on risk, totally different.
If you grew up with less, maybe you're much more cautious, scared of losing what little you have.
Precisely. Scarcity leaves a deep mark. Fear of loss can dominate. Whereas someone growing up with abundance might be more comfortable taking risks. Sometimes maybe even too comfortable.
Okay, that makes sense. What about bigger events like inflation?
Huge impact. If you live through a period of really high inflation where your money was visibly losing value fast.
You'd be laser focused on protecting against that, right? Investing differently than someone who only saw stable prices.
Absolutely. Or think about the Great Depression versus, say, the dot-com boom in the 90s.
Vastly different economic climates.
And likely leading to vastly different long-term financial philosophies, anxiety versus optimism, perhaps. Even where you live matters decades of stability, like in Australia, versus more frequent recessions like in the US. It shapes expectations.
So it's not just what happened in history, but your personal slice of it. There was that line in the source material.
Well, 0.00000000001% one.
Yeah. Your tiny personal experience can make up like 80% of how you think the whole financial system operates.
It's a powerful idea. It explains why smart people can look at the same data and come to wildly different conclusions about investing or risk or recessions.
It's not necessarily that one is right and one is wrong.
Often, it's just that their lived experiences taught them very different but equally valid lessons. Even within a big event like the Depression, experiences varied massively. Think about the Kennedys versus someone who lost everything.
Right. And you can read about it, study the numbers.
But you can't feel it secondhand. That fear, that uncertainty. A spreadsheet can show a market crash, sure.
But it can't model the gut feeling of risking your family's future on an investment.
Exactly. Some lessons, the really deep ones about risk and fear, they almost have to be experienced to truly sink in and change how you behave.
You need that emotional imprint.
You do. Which brings us to how something like your birth year or where you grew up can have such a, well, seemingly random but powerful effect.
Yeah, the sources talked about that National Bureau of Economic Research study.
Falmandier and Nagel, yeah.
Yeah.
They found investors' willingness to take risks is heavily influenced by their personal history, specifically the economic conditions during their formative years.
It's the dumb luck of when you happen to arrive on the economic scene.
Pretty much. Look at Bill Gross, the bond king.
Mm-hmm.
His huge success ran parallel to this massive, decades-long fall in interest rates, a huge tailwind for bonds.
Was someone from his dad's generation who maybe grew up with high inflation and rising rates.
Would have had a completely different view of bonds. They wouldn't have seen them as the same kind of wealth builder.
So your personal experience window really frames your opportunities and how you see them.
Definitely. Think about inflation again. Someone hitting adulthood in the U.S. in the 70s. They saw prices eroding savings dramatically.
That leaves a scar, financially speaking.
Compared to someone born in the 90s, where inflation has been mostly a non-issue, their instincts about it are just fundamentally different.
And location matters too, right? Local economies, job markets.
Absolutely. Unemployment rates aren't uniform. Entering the job market during a local downturn versus a boom time, that shapes your sense of security, your attitude towards spending and saving for years.
Okay, so if our personal history shapes us so much, it starts to explain why people make financial choices that look, well, crazy from the outside.
Exactly. The sources really push for understanding the narrative behind the decision. What story makes sense to that person given their life?
Which leads to that classic example, lottery tickets.
Ah, yes. The numbers are pretty wild. Americans spend more on lottery tickets than movies, games, music, sports events combined.
And it's often lower income folks spending the most.
Which seems completely backwards, right?
Yeah.
Especially when you hear that stat, what is it, 40% of Americans can't cover a $400 emergency?
So why spend precious dollars on something with astronomical odds against you?
Well, you have to try and see it from their perspective. If you're living paycheck to paycheck, maybe opportunities for real advancement feel limited, saving feels slow and difficult.
A lottery ticket is, what? A glimmer of hope.
It's a tangible dream, however unlikely. It's the chance, maybe the only chance they feel they have, to fundamentally change their life, escape financial stress.
Paying for the dream itself, almost.
That's how one source put it. It's a perspective someone in a more comfortable position might struggle to grasp. We might see it as wasted money. They might see it as buying hope.
Okay, I can see that. You don't have to endorse it as a financial strategy.
No, not at all.
But you can start to understand the why. It fits that idea.
Yeah.
What you're doing seems crazy, but I kind of get why you're doing it.
Precisely. And it reminds us that money decisions aren't just spreadsheets. They happen at the kitchen table, in meetings, influenced by ego, history, marketing, weird incentives, all feeding into a personal narrative.
It's messy.
Very. Another surprising thing the sources brought up is just how new the whole idea of retirement is.
Right. We sort of take it for granted now, but it's a relatively recent invention.
Very recent. Widespread retirement, as in a significant chunk of the population expecting not to work for the last part of their lives, that's really only about 2 generations old.
Before World War II, what was the norm?
You worked until you basically couldn't anymore or until you died. Look at labor force participation for men over 65. It was incredibly high until the 1940s.
Then Social Security came along.
Yes, but its initial impact wasn't huge. That first check Ida Mae Fuller got in 1940, pretty small, even adjusted for inflation.
It took a while to become a real safety net.
It did. Poverty rates among the elderly were still really high into the late 60s, and the idea of widespread private pensions is also kind of a myth, or at least more recent than we think.
Really? I always pictured pensions being common earlier.
The data suggests otherwise. EBRI data shows only a minority over 65 had pension income even by 1975. And it often wasn't a huge amount. There was a quote from a 1955 New York Times piece.
What did it say?
Something like, everyone talks about retirement, but hardly anyone can afford to actually do it. It captured the reality back then.
Wow. So the whole system we rely on now.
It's incredibly young. The 401k, that only came about in 1978.
And Roth IRAs.
Even newer 1998. So this idea of individual responsibility for funding potentially decades of retirement, it's a massive experiment, and we're still in the early stages, historically speaking.
That really puts things in perspective. Okay, shifting gears slightly, what about luck versus skill?
Ah, the eternal question in finance. And it's incredibly difficult to untangle the two.
The sources use that Bill Gates example.
Right. Bill Gates is obviously brilliant, driven. But he also attended one of the only high schools in the world with a computer in the late 60s. And his friend, Ken Evans, equally brilliant, maybe even more so according to some, died in a mountaineering accident before Microsoft took off.
So talent needs opportunity,
Yeah.
and sometimes just luck, good or bad.
Exactly. Robert Shiller, the Nobel laureate, basically admits we often just don't know how much is skill and how much is chance in investing outcomes.
And it's hard to talk about luck, isn't it?
Socially awkward, yeah. Pointing out someone else's luck sounds like sour grapes, like you're jealous.
And admitting your own success involved a lot of luck feels, I don't know, self-deprecating, undermining your hard work.
Right. Even though studies show things like income correlation between brothers is higher than for height or weight, suggesting background plays a huge role, people tend to downplay that luck factor in their own story.
It also makes it hard to learn clear lessons, doesn't it?
Definitely. Was that great investment outcome because of a genius insight, or did you just get lucky? Was that stock that went nowhere a bad decision, or just bad luck in a probabilistic game?
Our brains want simple stories. He succeeded because he was smart. She failed because she made a mistake.
But reality is usually much messier. Think about Cornelius Vanderbilt bending or breaking laws to build his railroad empire.
Worked out great for him. Huge wealth.
But was that bold genius or reckless disregard for rules that just happened to pay off? The line is blurry, especially looking back. It could easily have gone the other way.
Or Benjamin Graham, the father of value investing.
His single best investment, Geico, made him way more money than all his other investments combined.
But it violated his own rules about diversification.
Exactly. Was it a moment of unique insight that transcended his rules, or was it, well, getting lucky on one concentrated bet? It's hard to say for sure.
So the takeaway isn't necessarily to ignore outliers like Buffett.
No, but maybe don't try to emulate them directly because their results likely involve extreme factors, including luck, that you can't replicate.
Better to focus on broader patterns.
Yeah.
What works for more people more often.
That seems much more practical. And it ties into that Bill Gates quote.
The one about success.
Yeah. Success is a lousy teacher. It seduces smart people into thinking they can't lose. Acknowledging luck forces you to acknowledge its flip side risk, that things can go wrong even if you do everything right.
So the conclusion is, things are rarely as good or as bad as they seem on the surface.
That's a good way to put it. There's always more nuance, more hidden factors, including pure chance.
Okay, this leads us to the final and maybe most profound point from the sources. The idea of enough.
Yeah. Such a simple word, but incredibly hard to define and internalize, especially with money.
The story about Kurt Vonnegut and Joseph Heller.
At the billionaire's party. Classic. Vonnegut points out their host, a hedge fund manager, made more money in a single day than Heller earned from Catch-22 over its entire history.
And Heller's reply.
Yes, but I have something he'll never have. Vonnegut asks what? Heller says, enough.
Wow, that hits hard, knowing when you have enough.
It's a powerful realization. And you contrast that with someone like Rajat Gupta. Phenomenally successful, reached the absolute pinnacle of the business world.
And then insider trading charges. Lost everything.
Makes you wonder, doesn't it? Was it just greed? Or was it this inability to feel like he had enough, maybe driven by constantly comparing himself to the billionaires around him, that billionaire envy?
Or the long-term capital management guys.
Yeah.
Nobel laureates, brilliant traders, already incredibly wealthy.
And they blew up the fund, taking massive risks for gains they absolutely did not need, risking what they had and needed for something they didn't.
Which is exactly what Warren Buffett warns against.
Buffett's quote is perfect. It's insane to risk what you have and need for something you don't have and don't need.
But it's so easy to keep moving the goalposts.
Right.
You reach one financial target and immediately start looking at the next one.
It's human nature, I think. Social comparison is a powerful force. Keeping up with the Joneses, or these days, the Zuckerbergs.
How do you combat that?
You have to build your own internal benchmark of satisfaction. Decide what enough looks like for you, independent of what others have or what society tells you.
And recognize that some things are just not worth risking, ever.
Absolutely.
Yeah.
Your reputation, your freedom, your family, your happiness. No amount of potential financial gain is worth jeopardizing those. Knowing when you have enough to protect those invaluable things, that's the real key.
Okay, so let's try to wrap this up. What are the big takeaways from this deep dive?
Well, I think number one is that our financial choices are deeply, deeply personal. They're shaped by our unique histories, our experiences, our emotions.
So what looks irrational from the outside might make perfect sense once you understand the person's story.
Exactly. Which hopefully leads to a bit more empathy for ourselves and for others. And understanding our own biases can help us make better decisions.
And then there's acknowledging luck and risk. Things aren't always as straightforward as skill leads to success. Mistakes lead to failure.
Right. Chance plays a huge role. Accepting that helps manage expectations and maybe avoid costly overconfidence.
And finally, that crucial idea of defining enough, finding satisfaction independent of constant comparison.
Knowing when to stop chasing more and protect what truly matters. It's fundamental to long-term well-being, not just financial, but overall life satisfaction. Thinking back to when you first started investing, did the economic climate of that time influence your initial choices?
That's a really interesting question for you listening to reflect on. Think about a financial decision you've made, or maybe one someone you know made that seemed odd at the time.
Could understanding their background, their personal history with money shed new light on it? Does the psychology we've talked about offer a different perspective?
And maybe ask yourself, what are your benchmarks for enough? How did your own life experiences shape those? Are they really your goals, or are they influenced by comparisons?
Reflecting on your own journey, the different stages, the ups and downs, how events changed your view of money can be really powerful.
Hopefully, these insights can help you make financial decisions that feel more informed and more authentically aligned with your own life and values.
Food for thought, definitely.
Thanks for taking this deep dive with us today.